Yeah. So ratio calculations. TJF is national supermarket chain selling food, clothes, and household appliances with a 31 December year end. That means this is a supermarket chain. They sell, like supermarket. What is that? And they sell some like food, clothes, and household appliances. And the year ends like at 31st December. Correct? Now, the finance director would like the management accountant to prepare some financial data and analysis to present to board. That means they want to like check the current year's performance with the previous year performance. Very simply understood. That's the reason why they are asking what they want the management accountant to prepare some financial data and analysis to present the board. That means they should analyze and present it to the board. Okay. They have provided the management accountant with extracts from the financial statements to assist them in their analysis. So 2004 years income statement is given very simply, and the balance sheet is also given. Okay, in the sense it's not full balance sheet, some extracts, and they have calculated 2004's ratios. Okay, first I want you to calculate all these ratios shown here right now. Come on, can you do that? We simultaneously would do gross profit margin. You should just tell me. You should tell me the formulas and I will just find out. Okay. Are you ready? Hello.
Yes, sir.
Yeah. So first one is
Yes,
gross
sir.
profit margin. Yeah. So what is gross profit margin formula?
Gross profit by revenue into 100%.
Gross profit by revenue into 100%. So will you find out gross profit margin right now? Come on, do that.
Yes.
Your gross profit is given here. Your revenue is given here. You tell me the ratio. Yes, what's the ratio? Hello.
Sir, doing it, sir.
Okay, okay. Simply you have to take this 1000 and divide by 17,835 now. And tell me what's the answer.
Sir, 5.6.
What?
5.6, sir.
Hoor, what? Yeah, what did
Yeah,
you
so
get, Hoor?
5.6.
Yeah, 5.6%. Okay. Now, this 5.6%, this is current years. No, sorry, previous years. Now we'll also see the question. See, the finance director has supplied the following information regarding events in the year 31st December 2005. Online food home delivery has increased by 25%. See, based upon these figures, what they are giving, they have given the current year figures also. And you can see clearly what was the sales previously 17,835. Okay. So what they are saying, the online food home delivery increased by like 25%. So they saw 25% increment in the sales. That means delivery is nothing but sales. They are delivering more and more, correct?
Yes.
So fine. So almost that much they are seeing, and they have given the revised figures also. Accordingly, the number of stores grew by 10% in the year. This was financed by long-term borrowings. That also they have given the long-term borrowings. Here the long-term borrowings are. Previous year also they had non-current liabilities. This year also they have non-current liabilities, and you can see an increment. Okay, because they are funding more by taking more loans, more liability to them. In the year ended 31st December, 40% of customers purchased at least one clothing item during the year, whereas 20% did in the previous year. And strong marketing campaign, everything is given. The new strengthened grocery supplier code of practice came into force to improve grocery retailers treatment of suppliers, and they are asking you to what actually to do. Whatever the ratios you are seeing here, the same ratios you have to calculate for the year 2005, correct? So, and you have to see whether the current year performance has been better compared to previous year performance or not. So for that, I want you to find out the gross profit margin for the 2005 year. Come on, can you do that, please? I'm waiting fast.
So.
Take the 2005 gross profit and take 2005 revenue and tell me the ratio. Hello, are you doing?
Yes, sir.
Okay. So what we will do, we will take 1540 divided by 20,510 into 100, and you tell me the ratio. This is for 2004. It's for 2005. I don't think you have that much that complicated calculation.
So
How much?
7.5%.
7. So what do you see? From 2004, you see a higher gross profit margin or not? It's a good sign. Yes, it's a very good sign. Okay.
Yes.
That means maybe the cost of whatever it is, we have been successful in some cost reduction probably, and we are it's a comparative thing what we are doing. We are seeing that the current year's gross profit margin is more than the previous year's gross profit margin. It shows a satisfactory performance by the company in in the area of earning prime profits. Okay, profits from the prime activity. Now, operating profit margin you have to find out. So, what is the formula for operating profit margin? PBIT by revenue into 100. Okay, so I think they have given the operating. So you can write on the formula also, and operating profit is clearly given. You take this 530 by 17,835 for 2004, and you take 650 by 20,510. Okay, PBIT by revenue, and you tell me the ratio of this year into 100 as well as this year into 100, and you tell me what is the performance like. Okay, fast.
So from 2.9%, it's increasing to 3.1%.
Okay, so it was like 2.9 previous year, na? Okay, and this year it is 3.1. This year's operating profit margin is like more than previous year. It's a good performance, correct or wrong?
Yes, sir.
2.9 is almost 3, so 3.1 is more than that. Now let's do ROC. What's the formula for ROC? Return on capital employed is equal to PBIT by, we can take equity plus non-current liabilities. Okay, that means equity plus debt. Debt is here long-term debt. So this current year's ROC is 7.1%. You can calculate here. So what's the what did I give you like the formula PBIT? So I'll take 650. This is 2005, and I'll take for 2004. That is 530 divided by equity, which is 5050 plus 3250, and here 4935 plus 2530 into 100. Come on, tell me what's the answer. What's the answer? I'm waiting. Hello. Can't you find
Yes,
out?
1 second.
Yeah.
So I'm getting the same one. I'm getting 8.
Okay, so 2004, what did you get? 2004
8.08.
is 7.1, correct? Something given, na? 2004, it is how much? 7.1. Okay. And here you are getting 8. So this is a better one, na? Better performance in this year, correct? That means for $1 investment in your business, you are making like a good amount of returns. Previously for $1, you were getting 7.1 cents. Now for $1, you are getting 8 cents. This is good, na? Hello.
Yes, sir, it is.
Yeah, so this is done. Now, yeah, now next one, current ratio. See, I won't write the formula and anything. Now you have to find out current ratio for both years and tell me. I'm showing the data. Come on, do that. Fine. CA by CL is the formula. Total current assets by total current liabilities. Now you see for which year you have to take for 2004 and 2005. Come on, do that. This shows the liquidity, short-term liquidity position of the company.
Sir, I'm getting 0.6 and 0.5.
Okay, 0.6 and 0.5. Let's see for 2004. So total current assets happens to be what
I
actually?
mean 0.5 for
Yeah, see, for
yeah.
2004 it is 1610 divided by, this is total current assets. Total current liability is how much? 2650, correct? And for 2005 it is 1570 divided by 2920. And you can see the like calculation. For 2004 they've got 0.61, correct? Is it that you got? And for 2005?
0.5.
So the liquidity has come down, correct? The liquidity position of the company has deteriorated. They have to seriously think about this. Why it has got deteriorated? Maybe their liability has increased, correct? That is, their obligations have increased. That has made them that has made the ratio to decrease. Okay.
Yes.
So they have to improve on that, and then we'll go for inventory holding period, payables payment period, interest coverage ratio. So inventory holding period, what is the formula? Let's see. So I will write down the formula here. Inventory holding period. You follow that formula, okay? Because like we have already discussed about all these formulas. Inventory holding period. What's the formula? Inventories by cost of sales into 365. Correct? So for 2004 they have given, for 2005 you have to find out what is the inventory. You have to take closing inventory. Inventory we can find out here 850, and here it is 1000. So 1000 and 850. What is the cost of sales? Uh, 17,835, 20,510. Come on, find out and tell me.
So I'm getting 15.1 and 20.4.
15.1 and
20.4, sir.
No. How come? Like cost of sales is, did I write the wrong thing there? I read revenue. What? I wrote revenue. Sorry. Oh, I'm extremely sorry. I wrote revenue. It's like 16,835 and 18,970. You should have told me, na? Sorry, you're writing revenue. It's cost of sales. Now you find out. Yeah. Come on, tell.
So 16.3 and 21.6.
16.3. 16.3 for which year? This year.
Yes, sir.
So I'll write 16 and here I'll write 22. Correct?
Indeed. Yes, sir.
Days. So what do you think? In like 2004, it was taking 22 days for you to convert your inventory into stock into cash. This time 16 days. This is a better year, na?
Yes, sir, it is.
In this year, you're converting like your inventory into cash in just 16 days. Okay. Now, next ratio. So this is this done, this done. Payables payment period and interest coverage ratio. So like these two ratios, I'm not going to write any formulas. Can you do that for me? I'm waiting. Fine. The data you have now, you have the textbook and data. Come on, you find out both the ratios. Let us see what you're going to do.
So the interest coverage ratio and
the payment, like that one, payables payment period, debt payment period. That's what. Yeah, I'm waiting. Like, what's the answer?
So 1 minute.
Yeah.
So the interest coverage ratio search for 2015 it's 3.2 and for 2014 it's 4.07.
Who did you get the answers for this? I'm waiting for your answers even. Yeah, I'm writing
Yes,
it
sir.
here. So you did interest coverage ratio first, correct? So interest coverage ratio is PBIT by finance cost. Okay. So your PBIT is your operating profit. So 530, 650. So 530. Just a second. Operating profit. 530 and 650. Correct. So PBIT by finance cost. Give something else for this. So how much like operating profit? 530 and 650. What is the finance cost given? 130 and 200, correct?
Yes, so 130 for 2004 and
Yeah.
5 is 200.
Yeah. Tell me what's the answer.
So I got 3.25 and 4.07.
Okay. So what do you think? This year the capacity was more, no? This year the capacity is less, correct? To make the fixed interest payment. Correct or wrong? This year you had 4.07 times more money to make this payment. This year you just have 3.25 times more money to make this payment. So this year was a year in which you had more capacity to make interest payments, correct? Now, what is the payables payment period? Calculation formula.
So trade payables by cost of sales
Cost
into
of sales
360.
365. Do that. Trade payables by cost of sales into 365. This is payables payment period. Okay. So what is the trade payables? Like how much that is like in the 2004, how much?
2,280
So
divided
your
by
trade
16.
payables is 2280 and it is 2100 then. 2280 by like cost of sales 16,835, correct?
Yes.
1,835 2,280 by 16,835. 2,280 by 16,835.
So I'm getting 40.4 and 49.4.
Yeah, so in this it's like 2,100 by 18,970 into 365. What did you get?
40.4 and 49.
40.4 and 49.4.
So here you are recovering your money you are taking more time. Here, sorry, here you are taking 49 days to make the payment. Here you are doing the payment in 40 days. That's good, correct?
Yes.
Hello. Yeah, so this
Yes.
is the calculation of ratios. See, based upon these calculations, I want you to make a report and give it to me tomorrow as a homework. Okay, that is a homework. And I want you to do small activities on your own. I don't see, I think ROC is like something which you can do. So activity 4 is a homework. See, simple. I can do that, but I want you to do homework. Activity 4 is a homework. Activity 2 is a big question we did. Activity 3 is a homework. Okay. Activity 3. If you are not getting, leave it. Like that's you leave that one. Working capital. What's the formula for working capital ratio? I'll give you the formula. You try. Can you try?
Yes, sir.
Yes, sir.
Okay. Working capital ratio. Working capital ratio is like you have the formula here. So you write down the formula. I'm dictating the formula for you. And you calculate and do the homework. But working capital ratio is also called as current assets by current liabilities. Okay. So this is a different name for current ratio. Current ratio is also called as working capital ratio. Understood? Current assets by current liabilities. Right now.
So it's the same as
Same
the current. Okay.
same thing. Yeah. So that also you need to do homework. Okay. So that activity is also a homework for you. Tomorrow I'm going to start subsidiary books, but before starting, if you have got any doubts, I'm there to explain you. Okay.
Yes, sir.
And yeah, where is that? Where's the activity? Activity 1, activity 2. Yeah, this activity you have homework, do that. This like activity 4 also. So like tomorrow we'll start subsidiary books, be ready for the class on time. Okay. And who
Yes, sir.
did I give you management accounting first chapter video? Did I give you?
Management accounting. No, sir.
Okay, I'm giving that, and you have the. I'm giving you the video. Just a second. You do that video today.
Okay.
Yeah, and I want to conduct a test on Monday for management accounting first chapter. Okay.
Okay,
Okay,
sir.
sir.
Okay, be ready and be prepared for that. Yeah. Thank you. See you tomorrow in the evening. Bye bye.
Thank you, sir.
Thank you. Thank you.